And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. So much for peak inflation. It's going to be a long summer. The main problem is that investors may not have the information on inflation they need to determine a bottom for the market for many months. In the meantime, there's a proliferation of ETFs this year designed to protect and provide some protection, at least, against inflation. Let's chat with the CEO of one of those funds. Christian Magoon is the CEO of Amplify ETFs. Mike Aikens, the CEO and founding partner of ETF Action. He's also joining us. And Dan Egan, my old friend, Betterment VP of Behavioral Finance and Investing, is going to join us shortly. Now, Christian, you started this Inflation Fighter ETF in the beginning of the year. We talked about it then in February. iWin is the symbol, auspicious time to start it, right at the start of February. And it initially attracted a lot of inflows, but it's been quietly sinking in the last week. This is a mix of stocks and commodity-like instruments. What's in this, and why is it, too, starting to sink?
Yeah, so there's a variety of assets in here. When you look at top holdings, you'll see everything from gold futures to soybeans to land development companies to fertilizer and timber stocks. So it's really a kind of a mix of scarce assets either in the form of commodities or stocks that are in the commodity business. But with this market, correlations are kind of going to one based off all the sell-off conditions. Most of these assets are starting to trade downward given the increase in volatility. In addition, kind of before Friday, Bob, we saw many investors talking to us about maybe thinking that inflation had peaked or that it was still transitory, and they obviously got surprised on Friday. So kind of a new day here starting out the week with Friday's bad inflation numbers. So we'll see kind of what happens once we get out of this kind of macro risk off of it.
Yeah, gold is your largest, gold futures are your largest single holding there. How is gold faring as an inflation hedge? I mean, it's flat this year, so I guess you could say it's performing well against equities, but why is it not doing even better? I mean, the gold defenders, these guys, when I go to them, they always say, oh, well, this year the dollar's been strong, so that's a problem for gold. But is that the only reason? I mean, it seems pretty clear to me gold demand has declined in China and probably India, too, so, maybe it's not such a great inflation hedge when you have this kind of weird macro environment.
Yeah, I think one of the things working against gold this year is that interest rates are rising, so there's more income to be had. And remember, gold doesn't deliver any income, so when there's not much out there to sit in cash, gold can be an effective alternative. But with rates rising, high interest savings accounts are maybe now paying 50 to 75 basis points. It makes it maybe a little less attractive from a gold perspective. So I think that's one of the factors in this mix, this crazy mix of inflation and rising rates.
Yeah, Mike, this is the problem with a really broad market decline, which is what we're seeing. Everything goes down. You've got your inflation hedges go down. Christian's got farmland in here, farmland partners, Texas Pacific Land. They're down, too. So all these holdings drop. Bitcoin drops. Land holdings drop. Gold drops. So it's very difficult at this point to figure out what should be doing, what individuals should be doing at this point.
Yeah, it's a tough market, that's for certain. I mean, I think the saying holds true. Everything correlates to one in the down market. Though I would argue there are pockets of strategies that have been forgotten about that are doing quite well this year. Obviously, energy and broad-based commodities are doing fantastically. The world's kind of forgot about them in the last decade as we've been, in a non-inflationary market, a growth-propelled market. But the folks that manage to hold on to those allocations within their portfolios are being rewarded nicely for staying the course with some of those strategies. And you're also seeing some strategies such as managed futures do well in this volatile market. More of that trend following with the long, short, in the futures markets. A number of ETFs in that space are doing quite well. So a traditional kind of buy and hold alt portfolio is doing what it's supposed to have done this year. The problem is so many of these strategies are used tactically, and as we know, trying to time when these strategies are going to add benefit to your portfolio is extremely difficult.
Yeah, it's just about impossible. The old adage is it's time in the markets, not timing the markets. That's one of my favorite old lines back from the 1990s. Let me move on and talk a little bit, Christian, about some other inflation fighting strategies. You have a dividend growth strategy, enhanced dividend ETF. It's got a lot of blue chip dividend payers in it. Chevron's in it, United Health, Johnson & Johnson. But it also has a kicker, a tactical call writing strategy. Explain that.
Yeah, so the ticker is DIVO, D-I-V-O, and it's companies that are growing their earnings as well as growing their dividends. And then the manager of the portfolio has the ability to tactically write covered calls on these blue chip companies to produce additional income. So this is a 5-star ETF. It's ahead of the S&P by about 10% year to date, and is paying a distribution of nearly 5% that pays out on a monthly basis. So those kind of high quality names that have a built-in hedge, and that hedge is growing their earnings, allows those names to be a little bit more attractive in volatile markets like this. And certainly if we get into a crash scenario, having blue chip companies that are profitable and strong balance sheets, we think will be helpful as well. Yeah. So Depot's definitely been kind of a highlight for us at Amplify this year in terms of performance and assets under management growth.
Right. So if the S&P is down 20%, it's down, what, about 10% so far this year?
That's right. Yeah, I think coming into today, the S&P was down close to 18%, and we were down a little over 7%. So there's been some less kind of downside participation, if you will, from Devo than just owning the market.
And I'm rather surprised you can get 5% annualized return out of this. I mean, the top end oil companies are doing, what, 4% or so? How are you, and Johnson & Johnson isn't close to that. How are you getting 5%?
Yeah, so the dividend income of about 5%, about 2% comes from actual dividends from the stocks that are held by the ETF. An additional 2 to 3% has come from option writing or covered call premiums. So that's how you get to that 5%. The interesting thing about this ETF is as volatility in VIX increases, there'll be more option income that can be harvested. So historically, the strategy has had a 4 to 7% total yield, and that's again from dividends and option writing income. So, you know, being at around 5% right now, we've been at the low end, but volatility hasn't been that high over the last 4 or 5 years. If we get into a higher volatility, we could get up to that 7% range.
But so what's the downside? Under what circumstances would it underperform just owning, say, the S&P 500?
Yeah, so in big growth markets where growth stocks are favored, where, you know, S&P 500 is market cap weighted and has a big exposure to technology, Devo doesn't. It's really a blend of growth and value with a bit of a tilt towards value. It looks a lot more like a Dow Jones Industrial Average type portfolio than an S&P portfolio. So when markets are up big, especially on tech, Devo underperforms. But you know, in other cases where the market's more balanced or more volatile, this is definitely a more stable blue chip approach that we think can stand the test of time, and it has, as its 5-star rating suggests.
Mike, there are dozens of these enhanced dividend strategies out there. We've been covering them for many years, everywhere from just buying the highest priced dividend payers out there, which is a bit risky, to those that are consistently growing their dividends year over year, the so-called S&P aristocrats, as we say. And there are other sub-variants of this. How are they performing this year? And the spread is still pretty small. You can in this case of Devo, they've got a little kicker in there that's a major part of this, which is buying the covered call strategy. But most pure play dividend enhancers don't have that, do they?
Yeah, I think if you're looking at a long only equity strategy and you were to look across the dividend landscape year to date, one, they've been on fire from a flows perspective. You've seen a ton of money coming into these strategies. But if you think about it from a performance perspective, you've really seen an inverse of what we've seen historically or over the last decade in this space, and that is the high yielders are winning. So those strategies that are owning the deepest value, thinking of yield as a value screen, are performing the best. So kind of your traditional DVY type strategies or SDOG is doing really well. The funds that are focusing purely on yield and going after that are significantly outperforming those that have put in additional screens around quality or consistency of growth, like a VIG, for example, which has done very well in a growth environment, is not doing so well in this environment. On the option income or the derivative income side of the equation, where Devo would fall, I have to give a hat tip to Christian and team. Devo has done extremely well over the last 5 years relative to the S&P 500. Historically speaking, if you just look at a passive derivative income or buy right covered call type strategy, you give up a significant amount of performance during up markets because you keep getting called away, right? You're writing these covered calls, the market goes up, it gets called away, you lose that gap in performance. So if you take something that's a passive like a PVP or a QYLD, over the past 3 to 5 years, they've significantly lagged their benchmark, whether it be the S&P 500 or the NASDAQ 100. Devo is much more tactical. It's an active strategy. And if you look at it from a historical performance perspective, it's managed to deliver that extra income while maintaining a nice up-down capture ratio. And I'm just looking at it on my screen right now. It's kept up with the S&P 500 with much lower volatility over the past 5 years. And I think that really kind of lends to that idea of a tactical overlay versus a pure passive writing calls on a broad index. Over time, that type of strategy is going to lose ground significantly to the marketplace because we're in more up markets than we are down. So I think the tactical active overlay in this case makes a lot of sense if you're looking at the derivative income space.
That's a great point. A tactical overlay like we're seeing in Devo makes sense in when the market is like this, but it would have not necessarily done as well in the consistent up market. Christian, I just want to move on here. I want to ask you about the growth part of your portfolio. Amplify has a number of ETFs. You have a transformational data sharing ETF, Block BLOK. That was a big hit last year. You and I talked about it several times on air in 2021. It attracted a lot of inflows, but it's mostly equities focused on blockchain technology. So you've got MicroStrategy and CME Group in it. And it's tended to move with Bitcoin. So with Bitcoin in a new low today, so is Block. And just give us your thoughts on crypto here. Do you anticipate outflows from this fund, or how is it doing?
Yeah, so the fund is actually down for the year and seen a fair amount of outflows. It really is one of the highest correlated, publicly traded ways to access kind of Bitcoin type returns. It's because many of the holdings are highly correlated, like a MicroStrategy, for example, to Bitcoin. But ultimately, Block's investment thesis is on blockchain technology, which is, a broad-based technology of which one application is crypto. So we think there are other use cases, whether that's payment systems, third-party validation of transactions, data recording, et cetera. I think there's other applications besides crypto that are coming that will be, game changers and good growth opportunities to invest in. So we're still bullish on the whole blockchain space. We understand how volatile it can be. We launched back in 2018 and, saw Bitcoin go from 19,000 to about 4,000 in price before it rallied significantly. So we've been there with this fund before, and we've been able to come back and see strong performance. So I think volatility will continue, but we don't think over the next 3 to 5 years that these recent highs we're at are insurmountable. We think we can overcome those over time.
Okay. I want to bring in Dan Egan. He's the Betterment's Vice President of Behavioral Finance and Investing, and an old friend of mine. Dan, I often bring you in during dramatic market moments to help sort of calm things down, bring a little perspective. Let's put the adults in the room here. One of the big classic mistakes we always see investors make is trying to time the markets, thinking they know when to get in and get out. And then another one, which breaks my heart, I have seen it many times in my 32 years at CNBC, is selling at bottoms. So remind us what the right way to think about this is, what we're going through right now, and what are you telling your clients at Betterment?
One of the nice things that I've seen kind of over the past 2 decades is this transfer from people having to manage their portfolios themselves, going into brokerage accounts to place trades, even rebalancing trades or your common buy trades, with people investing in 401ks and even automated digital advisors like Betterment. We're seeing much more consistent investing behavior. So far what I've seen through this, it's been a scary period, but we aren't seeing people freak out in any way whatsoever. Everybody who has had auto deposits or 401k contributions set up, that continues to chug on relentlessly. There hasn't been any fear factor there. And additionally, we're seeing very little kind of like defensive movement, even in allocations. So for context, Betterment has 700,000 plus customers. Of those, over the past week, when things started to get scary, we saw about 50 or 60 defensive allocation changes, which is just not that much. Conversely, we saw about 200 unexpected kind of like new novel deposits of people putting money in. So the ratio is still very much kind of like stay invested, keep chugging along. Don't pay too much attention to your investments. This might be different if you're on a brokerage app or a trading thing. But a lot of our customers, they seem to be holding the line pretty easily because they're not focused on doing it themselves.
Yeah. I want to get back to trading in a minute, but you and I were talking last week on the phone about what looks like a slowdown in housing. At least the numbers are indicating that. You had a very interesting point. You noted that withdrawals to buy a house had slowed down significantly on your website. Tell us about that, and what does it mean? Is there signs froth really is coming out of the housing market?
Yeah, one of our favorite goals that customers set up at Betterment is a house down payment goal. It's a bittersweet moment when a client finally manages to withdraw to put the money down on the house that they probably wanted. And we've seen very high activity of those withdrawals over the past 2-3 years for obvious reasons. We're starting to see that reduce quite a bit as affordability goes down, and people aren't not saving for that house down payment, but they're setting higher targets and they're extending their time frame further into the future. So definitely seeing, at least for us, a good thing of people saving longer and for higher balances, but less froth in the market of actually I'm going to pay it right now.
I want to go back. That's interesting. I want to go back to the flow, the trading flows. And one of the things that we've seen this year is there is continuing to be a core foundation of inflows into plain vanilla exchange traded funds. Tell us about your experience. Essentially, it looks a lot like auto deposits to me. This seems to be sort of apathetic to the markets. This is just robo investing, essentially. Are you seeing that right now as well?
I would say yes. I would say they're less short-termist. So let's take a slightly longer time frame. You go back 3 years. Your total return on the S&P 500 is about 40%, I think, over a 3-year period. This is not some horrible thing for your average investor who's invested over the past 3 years. This is not the signs of panic and, oh, I've made a horrible decision. So for people who are investing, and generally we talk about somebody investing for at least 3+ years, and the further out you go, if you're talking about your kid's college education or retirement, these are things where you don't get distracted by really short-term ups and downs in the market because your focus is on something that's 10+ years away. And it makes it really easy to sit through these ups and downs and say, maybe this is more of a buying opportunity than a freak out opportunity. That mindset, that mentality of the money is going to be here for a long term, so drawdowns aren't a horrible thing. It's something unique to investors, not traders.
Yeah. Is anybody buying the dips right now? Do you see anybody suddenly taking large chunks of money, I mean, for a retail person, $20,000, $30,000, $40,000, and just saying, I'm betting on the bottom here? Or is that not happening?
I think what we've seen is that it's already been happening. I think it's been happening for probably the past month or so. People got very used to the idea of buying the dip, it'll rebound quickly, such that all they needed was sort of a 5%, 10% drop in order to trigger that behavior. I think that dry powder has been used up at this point. And the inflows we're seeing are always the more consistent ones, or people who have had an unexpected windfall, money coming in, tax returns, et cetera.
Yeah. Mike, you get the last word here. What's encouraging here to hear Dan talk about is, and maybe this is because the Betterment crowd is slightly older, maybe they've got a little more experience doing this, or maybe they're just listening to Dan more, but inflows are fairly consistent in these plain vanilla ETFs, despite the gyrations that we've seen this year. Tell us what you're seeing and what that tells you.
Yeah, I think it's a combination of things. I mean, you have to kind of break the ETF market between, buy and hold beta strategies that you and Dan were just talking about, and more tactical strategies. And you can even do that within the S&P 500 tracking ETFs, right? Like SPY is more of a trading vehicle than IVV or VOO. And you're clearly seeing that those long-term holding vehicles continue to pull in assets. I think one thing you have to remember with ETF flows staying more consistent than mutual fund flows is that you're continuing to get a tailwind of folks transferring from mutual funds to ETFs. And I think every time over the last 10 years, where we've seen a significant disruption in the marketplace, where the whole market is down significantly, ETF flows actually pick up, and that's largely can be attributed to the fact that folks that were sitting on legacy long-term gains in vehicles like a mutual fund now have an opportunity to roll into a more tax-efficient ETF without the same consequences. And on top of that, you continue to have withdrawals out of 401ks, folks that are required minimum distributions. And as that money comes out, if they're not taking it and putting it to work, they want to leave it in the market, it flows out of that qualified money into a more tax-efficient vehicle like an ETF. So ETFs have really proven time and time again that when the market pulls back and people have an opportunity to reallocate, their choice is the ETF vehicle for its tax efficiency, its liquidity, and its lower costs.
Yeah, that makes a lot of sense. All right, guys, we're going to have to leave it there. That does it for this week's ETF Edge. My thanks to Dan and Mike and Christian. We've asked Mike to stick around for a few minutes longer for some insights on ETF flows during these crazy markets. This is the ETF Edge podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.